Listen up because this is important. Common-size financial statements are a powerful tool for investors of all levels. They provide a standardized way to evaluate financial data. They help you compare companies, even if they're in different industries or have vastly different revenues. This is crucial for making informed investment decisions. Think of it like this. You wouldn't compare apples to oranges, right? Each fruit has its own unique characteristics. Common-size statements solve this problem by transforming all the numbers in a financial statement into percentages. This levels the playing field. Instead of looking at absolute dollar amounts, you're looking at each item as a percentage of a base figure. This base figure is usually total sales or total assets. This makes it easier to see the big picture and spot trends. You can quickly identify areas of strength and weakness. Whether you're a seasoned pro or just starting out, common-size statements can give you a clearer understanding of a company's financial health. They simplify complex data. Don't underestimate the power of this simple but effective tool. It can be a game changer in your financial analysis. So how do we actually create these common-size statements? It's all about percentages. For income statements, we use total revenue as the base. Each line item, like cost of goods sold or operating expenses, is then expressed as a percentage of total revenue. For balance sheets, we use total assets as the base. Each asset and liability is then shown as a percentage of total assets. This standardized approach allows for meaningful comparisons across different companies and time periods. By converting everything to percentages, we eliminate the distortion caused by differences in company size. This allows us to focus on the underlying trends and make more informed investment decisions. Let's look at a simple example to understand the power of common-size statements. Imagine two companies, Company A with $100 million in revenue and Company B with $1 billion in revenue. At first glance, Company B seems much larger and more successful. However, Company A might have a higher gross profit margin, even though Company B has a larger gross profit in absolute dollars. This means Company A is more efficient in generating profit from its revenue. Common-size statements would reveal this difference, allowing you to see that Company A is more efficient at managing its cost of goods sold. This efficiency is crucial for long-term sustainability. This insight wouldn't be as obvious by simply looking at the raw dollar amounts. Raw figures can be misleading without context. By comparing common-size statements over time, we can also identify trends within a company. These trends can provide valuable insights into the company's operational efficiency. For instance, is the cost of goods sold increasing as a percentage of revenue? This could be a sign of declining efficiency. This could indicate a potential problem that needs to be addressed promptly to avoid future issues. Common-size statements help us spot these red flags early, enabling proactive measures to maintain financial health. The real magic of common-size statements lies in their ability to compare companies of different sizes, making complex financial data more digestible and comparable. Let's say you're comparing a small startup to a large corporation. At first glance, their financial statements might seem worlds apart. Comparing their raw financials would be like comparing a scooter to a freight train. Not very useful. The scale and scope are just too different. Common-size statements level the playing field by expressing everything as a percentage of a base figure, such as total revenue or total assets. This allows you to see, for example, if the startup is spending a disproportionate amount on marketing compared to the industry giant, or if the large corporation is allocating more to research and development. By using common-size statements, investors can make more informed decisions about where to allocate their capital, regardless of company size. They can identify trends and spot potential red flags. Remember, it's all about finding the best opportunities, and common-size statements are a valuable tool to have in your arsenal. They provide clarity and insight, helping you make smarter investment choices. Thanks for tuning in to MindSpark channel. If you found this video helpful, give it a thumbs up, hit that subscribe button, and share it with your friends. Got questions or topics you'd like us to cover? Drop them in the comments below. See you next time.